Let's turn back to the panel for more thoughts here, and maybe we'll go in reverse order. So, Jim, the 10-year, it's up like a couple of basis points, not a huge mover so far. What jumps out to you?
So, look, I mean, effectively, there's a long period of time between the next meetings. So the next Fed meeting is March 19th. We get a couple of labor reports. We get a couple of inflation data points. We have a new president, new policies that are coming through. I think the Fed is right to be pause and be as really obscure as they possibly can at this point. So what's really jumping out to me effectively is how the Fed is thinking about the labor market. I think the inflation component is pretty well entrenched. It seems like it's relatively low and stable, and that's what I expect. But it's really the labor market. It's all of the adjustments that we get. We get these QCEW adjustments that always adjust things down, so the labor market may not be as strong as the headline numbers suggest. And I think that's really the worry point for the Fed, is that they're just not 100% certain on how strong the labor market actually is or is not, and that's going to make them react to hiking, or not hiking, but cutting more so than anything else. I don't think a hike is in the equation for this year.
Fair enough, Jim. And Dave, I was kind of making a point because the commentary, David, has been so positive. It's kind of weird that we're talking about rate cuts, and the Fed has already cut rates when a lot of the rhetoric around it is actually fairly good. That said, and I don't want to drag politics kicking and screaming into this. We try to avoid that. There's plenty of other channels that do it. But I think Steve's point was well taken, David, which is that if we don't know what the policies are ultimately going to be around inflation and jobs and immigration, whatever, isn't it much harder for the Fed to do their job because they kind of got to wait and see what some of these policies are?
Well, that's right. And if you sort of go back 6 months ago, I mean, 6 months ago, you could have said the unemployment rate's going up, but maybe it's not a problem. Inflation's coming down, but and maybe it's going to head towards 2%. Now we sort of settled into really very close to an equilibrium, but it's a hot equilibrium. We've got inflation a little bit above 2%. We've got an unemployment rate pretty low here, and then all the risk in terms of, what do we do in tariffs, what do we do in immigration, what do we do in fiscal stimulus, all of it has a potential for lifting inflation. So from the Fed's perspective, they really don't want to cut here, and I think the message is please don't expect a cut anytime soon from us here, because the last thing they want to do is have to hike rates or try to hike rates later on in the year if they feel like they've overdone it. So I think they'd really like to wait a while here before making their next move.
Stephanie,
hey, Brian,
go ahead. Go ahead.
I just wanted to add something very quickly to that, which is that I think the Trump administration is going to suffer a little bit from the lessons learned in the Biden administration. I think if you ask your average Fed official, they'd say, maybe we should have responded a little more forcefully and changed course perhaps a little more quickly when it came to the stimulus from the Biden administration. So I think they'll be a little bit more on their toes about fiscal policy. Now, some of the Trump administration may see that as being hypocritical or however, but the Fed is really good at fighting the last war, and that's one of the wars they'll be fighting, I think, which is this idea that we need to be on our toes when fiscal policy changes.
So true. And Stephanie, I don't know if the next question will be relevant to that or not, but I was going to say, what for you is the most important data? I mean, is it still jobs report? Is it inflation, consumer confidence? Or is it just, like to Steve's point, what comes out of the White House?
Yeah, I mean, of course, what comes out of the White House is going to be quite important. Granted, we might not get information on that right now, which is why the Fed can't really react, and it makes sense for them to not do all that much. From a data perspective, employment cost index this week is going to be very important to gauge to what extent the labor markets are inflationary or not. Our base case is they're not that inflationary right now. But we are worried about the pace of immigration really starting to tighten the labor market. And I think this is not really widely discussed enough. If we really start to see 3.6 million visas roll off over the next 2 years, that's likely to tighten the labor market pretty substantially. And it's going to make the job for the Fed quite difficult.
Yeah, and I think, Jim, listen, ultimately we can get into these theoretical discussions because we don't know what's going to happen. But I do know this, is that a lot of our viewers and listeners care about what happens to their 401ks, their 529s, their Roth and other IRAs and their stock funds and whatever it may be. The bond market has kind of done its own thing, right? It's raised rates even as the Fed has cut rates. So what do you and your team at Morgan Stanley see with rates and equities and bonds going forward?
So it's a really good question because effectively monetary policy is no longer the only game in town. Fiscal policy is going to play a major role. This is something that we all have to digest, we all have to take on board, and we all have to incorporate into our investment decision-making process. What the Trump administration is trying to do is have easier fiscal policy, taxes, deregulation, things like that, to generate growth and also keep inflation low. Those three things don't often hang together. So essentially, what the Trump administration is trying to do is, through deregulation, move some of the activity, business activity, more to the mid-cap sector. So we still like the equity markets. We still think equities are a good investment, but we think it's true in the broader markets, more in the mid-cap sectors, where some of the deregulation and fiscal growth policies might have the biggest impact. On bonds, we're relatively neutral. We don't think there's going to be a recession, so we think default risks stay relatively low. We think you're going to get the coupon in bonds, but I don't think much more than that. So essentially, it's really a balanced portfolio. But if you ask me, I'm a little bit more optimistic on the outcomes here, and I want to entertain the possibility of an upside. So I'm a little bit more positive on the equity side. However, it's more in the broader markets, cyclicals, materials, industrials, things of that nature. The mid-cap sectors more so than just large-cap tech.